Let's first take a look at where we found our information that we're going to be running the regression analysis on. As mentioned in class, Yahoo Finance is a solid, free resource for, amateur investors. Not for financial experts. Financial experts get Bloomberg, ladies and gentlemen. One of the companies that I looked at in my analysis was 3M. Here under statistics, I was able to find the two factors that I'm looking at in my analysis, which will be the operating margin of the company and the forward annual dividend yield. So each of these, I took these figures and plugged them into a spreadsheet and selected 50 companies randomly, but well-known companies across several different industries. Here they are, just arranged alphabetically. Now that I have some basic data to analyze, I want to evaluate the relationship between operating margin and the company's dividend yield. So what I want to do is I want to run a linear regression or regression analysis. The first thing I'll need to do is set my y or dependent variable. In this case, that'll be my dividend yield. The next will be the x, or the independent variable, and in this case, I want to set the operating margin. Let's quickly review the results of our linear regression. Here we have our summary statistics. We had 50 observations, which we pulled manually off of good old Yahoo Finance. No Bloomberg here for these non-experts. We have our maximum, mean, standard deviation, some slightly alarming numbers there. Our correlation matrix, along the goodness of fit statistics, which is what we're really interested in because we're trying to draw some understanding. We're trying to predict the correlation between a company's operating margin and their dividend yield. So what we're looking at here is, let's pay attention to the R2, the R squared. So what R squared tells us, now it's not a predictive model, what R2 tells us is how well we fit the line. How much of the movement of the dividend percentage can be attributed to the operating margin. And this right here is what we have. Adjusted R squared is a lot like R squared, only it takes into account sample size. And as you can see, it actually pushes that number a little bit smaller. So that means that there's a little bit less of a correlation between the two. Let's look at a visual representation to try and give us a better idea. Now, my inclination was that a company with a higher operating margin would also have a higher dividend yield. My thinking being that the more a company is making, the more they get to keep for each dollar of sales, each dollar of revenue that they have, the more they can do with it, the more that they can invest back into the company, and the more that they can give back to shareholders. Looking at this model right here, it's actually trending downwards with all of the companies that we've taken into account. We have one outlier that's hanging out here, which is a high negative in the operating margin, but still with, probably among the top 30% on our sample here of 50 within the dividend yield. Let's revisit what these numbers mean first. So if you remember from finance, the operating margin is operating income, or EBIT, divided by net sales or revenue. What it is it's a snapshot of how much a company is making on each dollar of sales. The higher the percentage, the more they're earning per dollar of sales. Also, we have dividend yield. So a dividend yield is a financial ratio that tells us how much a company pays in dividends relative to its share price. Everything is relative. We were looking at companies among different industries, some being Japanese. We didn't want to compare yen to dollar. So what we're doing is we're looking at ratios. We're looking at percentages. That way, companies that may deal on a smaller scale, it's all still relative. They may pay high dividends, but what's the share price? This is useful for measuring how much cash flow investors are getting for each dollar they've invested. Now, when we look at our numbers, we see some of the companies that are in the negative for operating margin are still posting a very significantly high, considering our sample, everything is relative, very high dividend yield. Now that's the funny thing about operating margin. Operating margin is really only useful when you compare it against companies within the same industry. Let's look at BP. Let's look at Chevron. Let's look at ConocoPhillips. All of these. ConocoPhillips was the one that's probably really throwing off our prediction model or our fitness, our R2, because they have a negative 34.89% operating margin and still a 3.82% dividend yield. Now granted, the dividend yield percentage is probably because the oil prices have varied a little bit. Right here we have an example with ConocoPhillips, and we see how the prices over the past year have risen and dipped and risen and dipped. That may have something to do with that figure being maybe a little bit bloated, but it may be accurate. We also look at other companies within other industries. It's not necessarily a tangible good, but Wells & Fargo, these banking companies, 42.11% operating margin, but still kind of a, considering our sample, towards the high of the middle end of the road spectrum, 3.3% dividend yield. A couple of the other companies within banking, American Express, 26.43% operating margin and a 1.81% dividend yield. Now, what we'll need to do is we'll need to take some of these figures of companies that are within the same industry and compare them to one another. Now, granted, our sample size won't be quite as big. It won't be 50, but that right there might actually give us a better predictive model of how well these numbers are correlated in our model. I've gone ahead and pulled our figures for operating margin and dividend yield for our oil and gas related companies from our original sample of 50 off onto our page here. I'm going to run the regression again to see if there's any greater measure of statistical significance since we're looking at operational margins of companies that are better related than they were across all the industries that we looked at originally. My values are already plugged into my linear regression. Let's see what we got. Okay, again, we're looking at a very low R square, and again, remember that R square and the adjusted R square tells us how much of the movement of the dividend percentage can be attributed to the operating margin. This line is obviously very loosely based, just something that we can kind of put our eyes to, but all in all, these numbers are pretty random. They're all over the place. When we look at our other values that give us some measure of statistical significance, like our t-value, we usually look for a t-stat with a rule of thumb of about 1.65. 1.65, positive or negative, swinging positive correlation, negative correlation, gives us some measure of statistical significance of which there is none with these samples that we've pulled together here. All in all, my theory was wrong. I thought that there was going to be a positive relationship, a positive statistically significant relationship between a company's operation margin and their dividend yield. In my mind, I thought that if a company had a better operation margin, if they were making more with their money, they had more to do with it, then they could give more back to the investors. After running the back test today, I'm glad to find out this is not the way that I'll be investing my money.